All right, this is for everybody who's looking to discharge a debt and you're in that patriot movement and you're being labeled a sovereign citizen. I just want to share with you something that you might find interesting. Again, this is just my interpretation of the research that I've done myself. So I'm going to go over it really quick, right? So we're talking about fiat money, right? Fiat money manufacturing. So fiat money basically is money that is unsecured. It's money. This money right here does not need to be printed into existence. It can be created on an account. And again, this money, which is a fiat of today, is not secured with metals. No gold, no silver, but instead it's secured with stocks and bonds, basically secured with financial assets, right? So to understand this, I highly recommend read the publication of Richard Werner. Richard Werner, read his stuff, man. He did a very good empirical study, and where he made a loan with a bank, and the bank agreed to show the internal accounting procedures of how all of this functions, and he found out that money is printed into existence. So first I want you to know that, or to grasp the idea that money equals dollars, right? The dollar bill is a fiat currency, but it is a debt. It's a debt. It's an obligation of the government. Now, it's secured by a stock or a bond. I'm going to show you, right? So this type of money is made through book entry. It doesn't have to be printed into existence, as long as it's entered as a book entry on the accounts. So we're going to go over it, right? This is what Professor Werner did. He went and he did a loan for $200,000, right? So now, here's a promissory note, which everybody has to sign and then give to the bank, right? And if the bank accepts these, it'll accept this as a bond. Remember what I said, right? Fiat is secured by a bond or a stock. So if the bank accepts this promissory note, it's going to accept it, but it's going to ledger it as a bond or some form of a financial asset. So this is what happened in the empirical studies of Richard Werner. He realized and he noticed that the bank opened an account and entered that bond into the account. And the bond entered into account credited the account. He has plus $200,000. Then what they did is they did some trickery in the accounts. They entered another entry, and this one is labeled loan account. And then they did a debit, they did a minus. So basically, they minus the 200,000 from the credit 200,000. Okay? Now this is how the money was created. The bank didn't get any money from somewhere else. It literally made a plus 200,000 and then a negative 200,000. And you'll see. Then what he realized on the account is that they converted one contract into two contracts. They split it. This is one contract and this is one contract. Why? Because this is what the account showed. Current account, which is this, is credited 200,000. So the balance on that account is a credit of 200,000. Number of contracts, one contract. But then the loan account, this went as a liability, and that was 200,000. So, but it was a deduction of 200,000, and that's another contract. So number of total contracts is two contracts, but these canceled each other out. There's a zero balance. Right? Now, this leads to the next part. Dollar manufacturing. What do I mean by that? So what they did is when they deducted the $200,000, they zeroed the account, but then this deduction went in as a customer deposit. That customer deposit was a credit, but it was $200,000. This is when the dollars were manufactured. All this is credit. Credit is not dollars. Okay? Credit is not dollars. Dollars comes from these instruments that create credit, and the credit can secure the dollars, meaning the financial asset can secure the obligations of the United States or of Belize or of Europe. Each dollar, whether it's US dollar, that's an obligation of the government of the United States. The Belize dollar, obligation of the government of Belize. The euro, obligation of the government of Europe. But this money, when it was customer deposit, this customer deposit is a public deposit, is a public money. This is why this money was magically created just like that through this process. Don't have to print it anymore. So now, if this is the money that was created on the customer deposit, this is brand new money. This did not exist. This wasn't borrowed from somebody else to lend somebody else. No. If you read the empirical study of Richard Werner, it'll tell you that the loan officer, the manager, all of them wrote in the form of like an affidavit or something, but basically said that they didn't get any money from another account. They didn't have reserve money to lend. They simply did a plus and a minus and some accounting magic, and money was created, meaning debt notes. Now, these are obligations of the government. This needs to be reported to the government because they need to be made aware that new money was made, because it's their obligation. They got to pay an interest on it. They got to pay the principal on it, because this is already secured. How is it secured? This secured it. This secured the credits. This secured the debits. The dollars created was secured because it provided the credits. Now, who is the owner of that? Who's the beneficial interest holder of that? Who holds right to this? Now remember, the account that was opened, the account was opened in the professor's name. The book entries was made in the account of the professor's name. All of these are in the professor's name. So if you would have made a loan, it would be in your name or your person's name. So the account created dollars. And because your account created dollars, you got to let the government know that new money was created on this account, and the account holder, which is the bank, is the one that manufactured it. Only banks can make money. Only banks is allowed to make money. So you got to report it to them that new money was created and the obligation has been secured. Boom. And now whoever secured the obligation, secured the new money, is entitled to interest plus the principal. Anyway, this is just an interpretation, an opinion. I'm not saying this is what it is. This is my interpretation so far. If this resonates with you, good. If you have something else that you need to add to this to improve it, or you want to point something out that's wrong right here, feel free, because we're just looking for truth. That's it. Peace and law.